Welcome to Illuminati Silver. We tell the truth about silver. Today is Sunday, the 1st of March 2020. And for all of those who are listening with a Welsh connection, happy St. David's Day. Now, yesterday we published our Gold and Silver Weekly Update for the week ending the 28th of February. And we've put a link in the description box below if you haven't had an opportunity to listen to it. Now, we pointed out in this video that the 3.5% fall in the gold price last week and the 9.8% fall in the silver price was to some degree to be expected, but certainly not necessarily all in one day, as it happened on Friday. Gold, and to a lesser extent silver, have seen their prices rise quite considerably over the past 12 months. Year on year, despite Friday's fall, gold is still up some 21% in US dollar terms and up 25% in sterling terms. Silver is up just over 7% in dollar terms and up just over 10.5% in sterling terms. The reason, obviously, for the higher percentage in sterling terms is because of the relative weakness of sterling to the dollar over that time period, although to some extent that has begun correcting itself. So even with Friday's fall, both gold and silver prices have proven positive. Now, when the trade crisis between China and the US began, and the fears of a world recession would result, some now 2 years ago or so, we stated that whilst we expected both gold and silver prices to rise, gold would be the better performer. Now, there were a number of reasons for this, but the two key reasons were, one, gold is seen as the truest monetary metal, or the true monetary metal, and in terms of uncertainty, would be where professional investors would flock. And two, silver being seen as a partial monetary metal would benefit, but would also be held back by any decline in industrial demand, which a global recession would obviously cause. And so even though its price would rise, it would be subservient to the price of gold. And this is why we've seen the divergence in the gold to silver ratio, which just over the past month has seen it move from 85 or below 85 to 1 to above 95 to 1. And over the past 3 years, from 68 to 1 to today's level of 95.1 to 1. And again this past week we've produced videos on this very subject. Now this divergence could still get even wider, though we suspect that the majority of the move has, in our opinion at least, been reached. Certainly until we actually get to learn what effect on global GDP both the trade war and the coronavirus has eventually had on it. So, what actually happened on Friday, we hear you ask? And we certainly have asked that question. Well, let's take a look at two articles published by Bloomberg in the last couple of days. Bloomberg article dated February 28th at 4:10 p.m. GMT and updated the same day at 10:20 p.m. GMT. Gold joins the virus sell-off with its biggest slide since 2013. It is an odd moment for gold to be tumbling. One of the oldest and most trusted safe havens in times of crises, gold typically rallies amid nasty stock sell-offs like the one that has gripped the world this week. So its plunge on Friday, it fell as much as 5%. The most in almost 7 years, caught many traders flat-footed and scrambling for explanations as to what had just happened. The most often heard of them, gold investors don't want to sell but are forced to cover the losses in other asset classes. It's a bloodshed, Commerzbank AG analyst Carsten Fritsch said by phone Friday. It first started with forced selling from equity investors who also sold their gold positions to cover their losses in equities and also to cover margin calls. gold investors don't want to sell, but are forced to cover the losses in other asset classes. The metal slid 3.6% to settle at $1,585.69 an ounce in New York on Friday. Other precious metals, including silver and platinum, also dropped, with palladium declining as much as 13%, the most since 2008. Fear over the economic fallout from the coronavirus has unnerved markets, sending the S&P 500 index to its worst week since 2008. The outbreak has further undercut investor demand for raw materials, which was already wavering because of increasing supplies and concerns over global trade wars. Returns from commodities have plunged on worries that the fast-spreading virus will crush demand for raw materials, fuel, and food across the globe. The rout is showing no signs of abating, as the virus continues to spread quickly outside of China, where the outbreak began. Major commodity trading houses are keeping employees from going abroad, and several events this week at the oil industry's biggest gathering were cancelled. Most exhibitors from China were forced to pull out of a big annual mining conference in Toronto next week because of international travel restrictions, a spokeswoman said on Thursday. The possibility that China may be using less is hurting commodity accounts, and therefore you're going to see margin calls, George Guerrero, a managing director at RBC Wealth Management, said by phone on Friday. Still, barring near-term profit-taking, risks for gold prices remain to the upside, amid expectations that the Federal Reserve will cut interest rates twice this year, some analysts said. The metal has still risen more than 4% this year, and Goldman Sachs Group Inc. has said it may hit $1,800 in 12 months. Quote, "We think that there will be opportunities to continue to add to long exposure," unquote, Suki Cooper, precious metals analyst at Standard Chartered Bank, said in a Bloomberg TV interview. "You might see a little bit of a sell-off, so there might be better entry levels. But beyond that, we think that upside risks still linger for gold." End of article. Bloomberg article dated February 29th, 2020, 1:30 p.m. GMT. Gold's volatility emptying jewellery boxes in a wild selling spree. Over the last few weeks, gold buyers have seen a frantic push by individuals racing to sell their little-used jewellery in the United States and Europe, amid worries that the extraordinary price rally fueled by the coronavirus since the start of the year may soon run its course. Old gold sales always jump when prices rise, but, quote, "We've never seen a surge like this," unquote, said Tabina Khan, the president of House of Khan Estate Jewelers in Chicago, where jewellery assessment bookings this week alone were up 12% over the average. The extraordinarily quick rise of the metal, which gained 8.4% this year through Thursday, piqued sellers' interest. But with so many unanswered questions swirling around the virus's advance and its effect on the global economy, no one is saying, "I want to wait because I think gold will go up even more," Khan said by telephone. They realise this is time sensitive. "It's a flight to safety rally," she said, "that's based on fear." On Friday, concerns about a slide became reality. After spot gold reached $1,689.31 an ounce in New York on February 24th, it slipped as low as $1,563 as investors sold the metal to cover losses in other asset classes. Rather than signalling an end to the rush that may actually boost it, the heaviest days for scrap jewellery usually occur when high prices start to slide, according to Ash Kundra, co-owner of J. Blundell & Sons Limited in London's Hatton Garden Jewellery District. Everyone is hedging their bets, he said. Kundra's shop paid out its highest price ever for scrap gold on the 24th of Feb, he added. Generally, scrap gold accounts for about 30% of total global supply. While the output from mining was flat in 2019, the amount of scrap gold in play probably rose by as much as 2.5%, according to Rohit Savant, an analyst at the research firm CPM Group. This year, though, there's been a significant increase, particularly as bullion priced in euros neared a record. European refiner Heraeus Holding GmbH said in an email. People have started to clean out their safes, Kundra said, adding that the majority of objects coming into his shop are from jewellery traders rather than walk-in customers or consumers. They find a packet that's been sitting there for 5 years, 10 years, and they scrap it to take advantage of the higher prices. While there's a race to sell in the United States and Europe, the situation is very different in China. There, sales of gold jewellery are set to plummet this year as the economic damage from the deadly coronavirus crisis widens. Shoppers are staying away from public places to avoid infection, while also limiting their spending to basic necessities such as groceries. Most buyers of gold jewellery pay sellers a fraction of the spot price. Recyclers and refiners then melt it down, purify it and form it into gold bars for coin fabricators and investors, or gold powder for industrial use. New York-based Empire Gold buyers ponies up roughly 96% of the going spot price for the jewellery it buys, according to Chief Executive Officer Jean Furman. A typical 18-karat gold wedding band weighing about 10 grams would gain a seller about $383 at a spot price of $1,600, he said. A gold watch weighing about 3 ounces and purchased for around $1,000 in the 1980s would probably gain a buyer around $1,900. Meanwhile, the value of high-quality watches like those made by Rolex, as well as some of the most expensive gold jewellery, comes from both the rising price of gold, which is what sends sellers to the marketplace in the first place, and the status it confers to the buyer. These items are resold rather than melted down. It's still gold, so the baseline of the value is still just the gold value, Furman said. But add that it's Cartier or Tiffany, and it shoots through the roof. Empire's phones are lit up like a Christmas tree, Furman said, and have been for 2 weeks. Meanwhile, traffic on Empire's website is up by about 40%. People who have been sitting at home thinking, time for me to sell, time for me to sell, are coming out of the trenches right now, he added. End of article. Okay, to summarise then, we do not believe that just one thing happened on Friday, but the culmination of a number of factors. And we shall now list these, but not necessarily in impact order or order of importance. 1. Profit-taking. 2. Equity loss coverage. People had taken a significant hit if you bear in mind that the Dow alone fell by 3,500 points last week alone. 3. Margin calls. These have to be covered. 4. Physical sales of old stock bought at much lower prices previously. And tied in with that, as mentioned in the article, perhaps a realization that maybe the prices had peaked. 5. Not often mentioned, automated selling as support levels were breached. Of course, traders very often feed into their systems algorithms that force sales should prices hit below a certain level. And equally, instigate buys as well. 6. A general move towards cash, in order to reinvest back into equities when the rout has finished. This is a really important point because we all assume in this marketplace that if equities fall, then people are selling their shares and therefore they will automatically put that money straight into gold, silver, bonds. But they can also put it into currency. As Warren Buffett has often said, that the best time to purchase equities is after a crash. And this is what many professional investors do. But you have to have the cash available in order to do that in the first place. And 7, potential manipulation in preparation for a rate cut. Now, frankly, we cannot rule out any of these, as they all seem logical, possible, and in most cases, likely. Of course, the pumpers are going to say it's all manipulation, as they could not possibly accept the fact that there can be times when people don't actually want gold and silver, or perhaps believe there is a better investment opportunity for them. And of course, the pumpers need this manipulation narrative in order to compel their listeners to buy now, because it cannot be manipulated forever. Well, guess what? If manipulation by governments or central banks were the prime mover of the gold and silver price, the dictator, if you like, of the price, were these micromanaging the gold and silver price on a daily basis? If you genuinely believe that is the case, and we're aware that some do, well, I have some news for you. They can manipulate that price, if that is what they're doing, not necessarily forever, but long enough until you are compelled to sell the stocks that you have at a loss, if that was their intent. Now, we certainly do suspect there are interventions, for sure, but they tend to be used to prevent frothing at the top and total collapse at the bottom. If you genuinely believe the governments wanted the gold price to remain at $1,400, well, how come it's risen above? And that's not manipulation. And yet, when it reaches $1,600 or $1,700, it's slapped down, so that is manipulation. It's illogical. But the people really to watch out for in the manipulation stakes are the investment banks and dubious funds attempting to deceive the markets in order to gain rapid and significant capital gains and profits. In other words, not manipulating it for some nefarious reason to keep the value of the dollar high or low, but more so to make a quick buck. But that's another matter. It was interesting to see that after yesterday's fall, there has been Friday's fall, there's been a spate of videos coming out reminding us that JP Morgan is holding millions and millions of ounces of silver, and they have plunged the markets because they intend to sell that silver, to buy more and then eventually to sell it at a peak. Okay. All in all, we believe that all 7 of these factors kicked in, more or less at once. And this has had a considerable effect on gold and silver prices on Friday. Now, what none of us know today is really which direction they're going to open tomorrow. Not if we're truly honest about it. Very often, we find it moderately easy to predict, but not tomorrow. Now, the main reason being is that there is a school of thought that the Fed will lower rates, and they could do it today. But if not today, then this week. Some 2 weeks or so ahead of its FOMC meeting, which is when interest rates are normally decided. Now, if that does happen, and we believe that it won't, but we could be wrong on this. If it does, then we will see gold prices in particular rise, because it would be an admittance by the Fed that the economy is in far worse shape than they thought. The dollar will fall and commodity prices will rise, especially gold. However, Silver may also rise, but again, if the purpose of that cut is a declining economy, then of course that rise will be tempered by the perceived fall in industrial demand that will result. Now, if of course the Fed does not lower rates, then as reported in our weekly update on Saturday, there is a significant amount of economic data being announced this coming week, which could seriously affect the equity markets, the dollar value, interest rate yields, and the price of gold and silver. Now, in addition to all of this, looking at the closing charts on Friday, there could be a possibility of a further $20 immediate decline in the price of gold when markets open, and certainly a 25-cent decline in the price of silver. So we have some mixed messages here, and much depends, quite frankly, on what happens geopolitically between now and Monday morning's opening. Our position at Illuminati Silver is that we are looking at any significant fall in the price of gold to be used as a small but conscientious buying opportunity. In other words, little but often. As far as silver is concerned, we may pick up the odd few ounces of scrap when there's excellent value to be had, but we still suspect the downward pressure has further to go. And it may be this week, but it may not be. But if global trade is seen as being even more adversely affected in the coming weeks, then we will see further lower prices. And then we will be buyers of silver again, and in quantity. But this could be a few weeks or a few months away, unless, of course, there is a sudden and unexpected drop, which is clearly overdone. Well, that's then another matter. So do stay tuned to our channel, certainly next week. Obviously, we'd like you to do it on a permanent basis, but we are now entering some quite interesting times, and Friday's fall has jolted a lot of investors' opinions. And if you haven't already done so, please join or subscribe to our Richard and Greg channel by clicking the link that we've placed in the description box below. As in that channel, we will be commenting on political and geopolitical issues that we may not really cover in any depth on this one anymore. Meanwhile, thank you for listening. Press the bell sign, please, if you have subscribed, to remind you of new videos as and when they are published. And meanwhile, watch the markets closely next week. They may reveal quite a lot. And do share your comments with us below. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.